Interesting statement by so many people is they look at the mortgage rates, say rates are too high, but they're only looking at one side of the trade. And they're also looking at a window of time that only existed really one time in history. And we're talking about from 2008 till 2021, when you had Ben Bernanke, Hank Paulson, and anybody else pulling the strings took created capital, injected it into these pools of funds to bring interest rates extremely low and completely blew our inflation through the freaking roof. So the question should not be, what is my interest rates? What's the money cost me? And because of inflation, the cost is vastly different than what you know it to be. What you have is a side of the trade, right, which is in one of the largest markets on the earth, which is the bond market, and you have people buying into that, deciding, traders or investors going into that, deciding, I need to have a return on my investment. I'm willing to put it at a certain point, and I will bid in this at a certain point where I believe it's at a value that I can get the return that I believe that I need. And then you are going to grab that capital, you're going to hang on to it, and you say, what can I control with this, and where I can put their capital to use, and what return can I make? So everybody's making a return. Your mortgage becomes an investment to them, but it becomes the biggest asset to you. You think you're going into debt, but in reality, you're locking up capital at today's value, stretching it out over tomorrow's value to pay it back. And the person who bought that or basically invested that capital with you is losing money significantly, but but they don't see it the way that we do. I see them taking a monster loss while we're using their capital that somebody else pays off while the asset continues to grow in my benefit. The appreciation, of course, is that growth. You have the tax deductions, you have the rent that you're raising, but our return, or at least our cost, stays flat. It doesn't go anywhere. So when you're trying to make a decision, say, where do I need to commit my money? You need to commit it to a market you can reasonably keep it rented, right? So a property that somebody's going to want to stay in, that you can raise rents on, and it's going to appreciate at least 2 to 2.5%. I know it doesn't sound like a lot, but you 20% down, let's say $100,000 property, put 20% down, it's 20 grand, right? But if the property is appreciating 2.5%, what is that? $2,500. It's $100,000 property. You invested 20,000. You are now over 10% return every single year if it appreciates at least 2.5%. That's not a hard thing to achieve. Somebody's paying off that mortgage, right? You're talking about a $80,000 loan. Now I know this is a small loan amount and probably something that we're not going to see a lot of, but you're talking about an $80,000 loan divided by 30 years. They're giving you $2,666 a year. Again, that's well over 2% of what you put in the down payment. Excuse me, over 10%. You're already 20+% return. And what is the return being made by the person who invested money with you? The person who put their money through the bond market that went into your deal? 7%, 7.5%. That's declining because you're paying them back with the US dollar. Guys, you don't want to miss what's really happening here, which is you are taking control of a better side of the deal when you lock in your trade and you trade with the bonds and you use that bond capital to invest in real estate. It's impossible to see the differentiation if you dig into this and start seeing exactly where that value lies. Now let's take a look at the charts and see what happened to those who were investing with you. What happened in their market? So we're going to look at the Fannie Mae 5.5. That's what I keep looking at. That's what I've been paying attention to for years, because that tells me I've been able to mark this thing up for over 10 years. To see exactly where things are going. I got a better idea of what's happening in the market right now. So as you see right here, I'm going to take this downward channel away because reality, it's not in play anymore. We had it in play. Now we're getting to where we're in this channel right here, this sideways channel between par 55 and par 08, basically. So right here is where people are trading and they're moving their money sideways through here, and it could just continue to go sideways because right now we're kind of in a limbo situation. What was driving the markets before? Of course, jobs. Now we got some, that news has kind of been used and it's not gone anywhere recently because of so much attention being pulled overseas with respect to the oil and other energy inflation. That right there is also not having as much influence. So we're seeing, people are looking around to see what's going to happen with the Fed now. Now we got the Fed as the main focus. What's going to happen there? They're not going to be giving as much forward indication as to what they're going to do, right? So people are now worried about that. So we're sitting kind of stagnant these last couple of days. So this is where we're sitting kind of sideways on our trades. We're not at our peak, which are the lowest interest rates we'd seen in the last year. We're not at our worst point, which we had seen just earlier this year. So when you start looking at over the last 12 months, man, my thing's jumping around here. We go back to September of last year. That's when we're really kind of at our actually, we should be going back to June. So June of last year, we were in a much worse position than we are right now when you take a look at what's going on here. So that all being said, that June a year ago was here. Look at how ugly that was compared to where we are now. We're in a much better rate position than we were back in June of last year. So this last year has been some really good rate movement for you. Now, we're not at our best position like we were in February. We're definitely not in our worst, and we're definitely not as bad as we were back a year ago. I'm in the mindset, hey, if the deal works, if you can take that capital that's coming into you and the payment is significantly less than what you're having to put out of what you're getting in the form of rents, that's the deal you need to look closely at. That's the deal you need to pay attention to. It's the deal you need to decide whether or not there's other factors that make it worthwhile, because the rate's not the driving point. If you're waiting around for the rates to come down, then you're waiting around for the prices to go up. Why wait for the prices to go up? You should take advantage of what's here, take advantage of what's now, because as they go up, rents will go up, prices will go up, equity will improve, somebody else can be paying down your mortgage, all because you jumped in now, you got in the game instead of waiting for something external thing to happen that we can't control. Control what you control, which is what property you're going to acquire. Can you keep it reasonably rented the entire time you own it? Is it something that you believe could raise rents and will it appreciate? That's it. And then set up your tax strategy properly so that way you can take advantage there. If you want to know about some of those things, let's schedule a call. Let's talk about it. aaronchapman.com. So quit jerking off. Let's get in the game.